Hello everyone, I hope you've all had a fantastic week. Welcome to today's Market Snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, it's not been a week short of talking points, thanks largely to the ECB meeting yesterday, Mario Draghi's taper tantrum during the press conference, in which he was extraordinarily insistent that the reduction in quantitative easing from the ECB is absolutely not tapering. It's just a reduction in asset purchase that may or may not be increased further down the line. Now, I don't know about you guys, but to me that sounds like a taper. The only difference is whereas the Fed announced that it was tapering and that it would be reducing its asset purchases so much every month with an end date in sight, the ECB have kept the cards a little closer to their chest, haven't announced an end date in sight, and are probably being forced to do this more so due to the lack of availability of assets to purchase, rather than the fact that, as with the Fed, that they're actually close to achieving their goals, because as we saw from the economic projections, they still see inflation at only 1.7% in 2019. So it seems strange that Mario Draghi acknowledges that they're not close to achieving their goals and yet decides, excuse me, that it's correct to start paring back their asset purchases each month, the stimulus that they have created in order to try and offer support for the Eurozone economy and try and achieve its only mandate of returning inflation to target, which is below but close to 2%. So apparently the technicalities matter, and clearly that is the case, because we did see the euro falling in the immediate aftermath of the ECB press conference and announcement. Mario Draghi always has been quite masterful with his wording, and yesterday proved that point, that despite reducing asset purchase, the euro actually fell. So quite an astonishing achievement there by Mario Draghi. Now, they did excuse me, again, announce other measures along with the reduction in asset purchase, and I think these also played their part in reducing in the euro falling. You can see here on the euro dollar chart actually that this was the initial reaction up to around 108.75 to the announcement that QE had been reduced from 80 billion euros a month to 60 billion euros a month, and then we saw this dramatic sell-off ending the day around 106, and now we find ourselves around 105.30. Now, I think what helped contribute to this was a few factors. One is that rather than being extended to September next year from March, it's actually been extended to December next year, and some people have tried their best to argue that 60 billion a month for 9 months is 540 billion, unless my maths has led me astray, or 80 billion a month for 6 months is only 480 billion. So in fact, this is actually more stimulus from the ECB rather than less, and that's why we saw that the euro reverse course. Now, I'm not buying this, because that fundamentally assumes that the ECB would have otherwise purchased 80 billion a month until September and then cut it dead altogether. That is absolutely not going to be what would have happened. If anything, they would have tapered it slightly or kept it the same, which means that in fact this is less stimulus. And really, I think people are just clutching at straws with this kind of argument. I think what made more of an impact is the fact that this announcement came very clearly and very intently alongside the announcement that they are removing the deposit rate floor for the bonds in which they purchase, which means there's a lot of German debt in particular which yields below than minus 0.4% deposit rate that the ECB has at the moment, that was unavailable because of the rules of the program for the ECB to purchase. And this was one of the things that that helped towards the scarcity of bonds available for the ECB. Now, that's been removed, so now the ECB can purchase as much of that debt as they want. They also increased the maturity of the debt that they can purchase. So previously, they could purchase bonds that with maturity between 2 years and 30 years. They've reduced that slightly to 1, so they've the lower end of the yield curve has been quite largely impacted as a result of that move. So again, just increasing the availability of bonds while reducing the amount of bonds they want to purchase. So I think these two offsetting forces also played a part in limiting the upside for the euro. But ultimately, I think Mario Draghi was absolutely determined to drive his message home. This is not tapering. Please don't freak out. This is just a temporary reduction that we may increase further down the line. They more than likely won't increase it because there's clear opposition to it. There's clear scarcity of available bonds. There's clearly opposition to allowing the ECB to purchase more than 33% of bonds that are available in the market, and the even more opposition, I would imagine, or what appears apparent, to changes in the capital key. The capital key being the amount of bonds from each country that the ECB must purchase. According to the rules of the program, the ECB must purchase the amount of bonds for each country depending on how much that country contributes to the ECB. Now, at the moment, Germany is by far the largest country contributing to that, and I think it's around 17.8 or 18% that the Bundesbank contributes to the ECB's balance sheet, and therefore around 17.8 or 18% of all bond purchases by the ECB under the quantitative easing program has to be German debt, and that's what leads to this scarcity issue which we have currently. Now, these two things which don't look like being removed yet, this is going to be a last resort, I think, for the ECB, something which I think it will have to reach a stage that even the Bundesbank themselves cannot oppose this before they start to look at this as a possible solution. But clearly there is significant opposition there right now, which is why, despite not being on course to hit its inflation target in 3 years, they reduce their quantitative easing and remove some of that stimulus. But anyway, the markets are bought in. That is all that matters at this moment in time. We've got the euro now trading back at around 105.35, approaching that zone, that important zone of support. You can see that around these 105.30s here is where we found support back in in December of last year, again back in April of last year, again back in November of this year, and excuse me, again in early December of this year. So this is clearly a very important support zone, and that is where we're seeing a lot of pressure now. Below here, if we see a break of this, then we could be looking at around these 105.20s, which is the multi-year low from March of last year. But at the moment, it looks like we are still finding support, although they are two very bearish candles, so I wouldn't be surprised to see the 105.20s being tested soon enough. It looks as though, from my perspective on the 4-hour chart at least, that we're not necessarily seeing any lacking momentum in this move either. So for me, this is looking quite bearish, and I think we could be looking at those 105.20s coming into play relatively shortly. Let's move on, sticking with the euro actually, let's go to euro sterling. Again, you can see that we've seen this sell-off, this reversal, this U-turn in the euro around these 85.70s. This was yesterday. We've seen a continuation of this move lower today. But what strikes me as being important here, and this is what the focal point for me on this euro sterling chart, is we've got a head and shoulders potentially forming. You can see here we've got one shoulder here, another shoulder here. Rather than have a single neckline though, I think we're looking at a bit of a neckline block around 83.40 through to 82.50. So this would be the aggressive break, if you want, if this is one that, if this was broken, and to some people this may be the neckline, so we could see an aggressive move through here. For the more conservative among us, we may be looking for a break of 82.50 for confirmation of the break of the neckline before we consider this a completed broken head and shoulders. And what I find important here as well is you can see that the 200 and 233 you can see here day simple moving averages have been quite important on this on the euro sterling pair throughout this process, providing resistance along the way down, providing some support on the way back up, and now they're coming back into play here. So a break of this 82.50 level in particular, or even just below here around 82.20, could be extremely crucial. This could be a very bearish move here, and given the benefit of head and shoulder providing possible price projections, this could be a very substantial move. Break of 82.50 with the neckline looking up around these 85.50s, for example. That's a 300 pip move. That's a 300 pip move, so that would take you down to around 79.50. This is all the way down here, so that's a very substantial move, and that is for the conservative projection as well. A net break of the neckline of 82.50 all the way up to the head, that's looking at a move of around 900 points. So that is a huge move. That is a very, very substantial move, which is what makes this such an important level. I mean, that takes the 82.50s through down to 73.50s. I mean, we're looking all the way down these levels. I mean, that just looks like an incredibly ambitious move. Should we see a break of that neckline. So I think this is going to be crucial. I think this is going to be certainly one to watch. And if we see a breakthrough, I'll be quite surprised. But secondly, I'll be feeling very bearish with regards to this pair. Let's have a look at euro yen. We can come back to dollar yen. I'm going to try and cover as many pairs as possible because it has been a few days since we did one of these videos, and so I want to cover as much as we can. So apologies if this is a slightly longer video today. Hopefully we'll get a lot covered. It is the weekend. I'm sure you've got plenty of time. No one's doing any holiday shopping or anything like that, enjoying the festivities. Everyone's clearly wanting to check out this video and hear my analysis, of course. But you can always skip ahead, skip back, and just pick the parts you want, and hopefully, touch wood, find it all useful. Now, like I say, this is euro yen here. Now, let me just stretch this chart out so we can bring these moving averages into play. You can see here that we saw a break through the Ichimoku cloud a while back at this stage, which moved this into bullish territory. Since then, this has certainly looked bullish. We've moved all the way as high as 123. We've broken through the 200 and 233 day simple moving averages. We've come back. We've retested on 2 occasions. The most recent of which was only a week ago. And now we appear to be stabilizing. It looks as though we're reaching the upper ends and maybe we're running out of a little bit of steam, which, given the significance of the rally we've seen recently, it shouldn't come as too much of a surprise to anyone, quite frankly. It is interesting that this is one of the few currencies that we are seeing the euro trading higher against on the day. That just shows that we are seeing a lot of weakness in the Japanese yen currently. And with that in mind, if we do see a move higher, and it does look like we are running out of steam, but if we do see a move higher, then we could be looking at these 124s through 125s. Now, this is a broad range, but this is previous resistance on a couple of occasions, and it's also the 38.2% retracement of the entire move from the highs back in December 2014 through to the lows on June of this year. So big level, and I think these 124s through to 125, if we do see it reach these levels, could prove to be a significant area of resistance and could be an area at which we start to see a bit of a correction, a bit of profit taking possibly if we reach that far. Like I say, it does look like we are running out a bit of a steam here. We did see this kind of double top form over the last few days with the high around those 123.35s, the neckline coming in around here around 122. And we haven't seen that move completed yet, so that may suggest that we're actually seeing a move. We could see a slightly larger move to the downside. And when I say we haven't seen that completed yet, what I mean is, like with the head and shoulders, you do get possible price projections from these levels when you see a break. So 122, say, through to 123.35. So of course that's a 135 pip move, so that'll take us back from 122 to around 120.65 ish. Again, these are only ever relatively rough. That would bring us back towards the cloud, back into the moving average band, which is a notable area of support, as it has been since we broke above here. So that would be a logical area where we would, if we did see some profit taken at this level, and we are still going to see some upside, that would be a logical area where we may see traders coming back in and buying back onto these dips, and then potentially seeing the market drive higher. So that would be a level, if we do reach here, that I will be keeping a close eye on. Now, I do think we possibly will see a reach here, because effectively what we've seen is we've seen a sharp sell-off off these highs, and this just looks like a typical holding pattern, a typical consolidation pattern. It looks to me like a bit of a rising channel potentially here, which is just a little bit of profit taken, a bit of consolidation before a move that goes in line with the trend which preceded it, and a move in line with the move that preceded it would be lower. So I'd be looking for a break below this rising channel, and then that could potentially open up the move back towards these 120.65, I think was the level that I said, around 120.50 maybe, which would complete that double top, and then potentially see the buyers coming back in at these levels. Now, while we're on the yen pairs, it's only fair to look at dollar yen, maybe a bit of sterling yen. Dollar yen, we remain in this rising channel. Now, I may have adjusted the boundary slightly from the last video if I'm not mistaken, but we've broken through this resistance. We've broken to new highs today. Again, this yen weakness really filtering through. But again, we are reaching a big resistance level here. So it's going to be very interesting to see what we get from the momentum indicators here, because we're reaching around these 116 levels. This is the 61.8% retracement of the entire move from the June 2015 highs through to the June 2016 lows. It's also a big prior level of support you can see here from August of last year. Again, from January of this year. This is a big level, 116, say through 116.20, big resistance level here. And if we see a move above there, again, this is a very bullish move. Now, if we look at the 4-hour chart, you can see that momentum is still holding up relatively well. The last few highs have been made on falling momentum on the MACD histogram and on the MACD moving averages. Not so much on the stochastic, but it's going to be very interesting to see how we trade around those 116s. And if we do see a rejection at those 116s, then the next thing I'm looking for, close eye on, is going to be how does the bottom of this rising channel respond, because you can see we had this aggressive move high, and the reason why I've added this channel is because this is effectively a flattening of the rally. Now this is one of the things that makes you think that the move is potentially running out of steam, and a break below that channel is what potentially indicates that we are going to see a sharper move to the downside. And you look at this support zone, you've got the Ichimoku cloud on the 4-hour chart, you've got the 55 and 89 period simple moving averages on the 4-hour chart and the bottom of that channel. Don't underestimate just how important a break that would be if we see a breakthrough 113 through to 113.50. That break is quite bearish in the short term, and may therefore suggest that we are going to see a broader correction, which again, as I said on Euro, very sharp rally corrections are necessary, they are good, and they do more importantly happen. Oh, not sterling dollar, I'm looking for sterling yen here. Again, the same is true. I mean, we're looking at the same type of thing on all of these yen pairs. We've seen this rally. We're in a rising channel. Again, I have adjusted the parameters of this channel because we saw a break below and it formed what appeared to be a better suited channel on this case. So we are still trading higher, but again, we're still trading in this moving average band. It was rejected at the first time of asking. It'll be very interesting to see if we can see a break above these 146 levels on this occasion, because with the momentum is still very much to the upside at this stage, potentially starting to fall out, but the trend is still your friend at this stage. And until we see a rejection of that, then I think for me, I've got to remain bullish but skeptical, of course, because again, look at these momentum indicators. Momentum is very much falling out of this move, so this makes me a little bit cautious on this move, but the trend is very much still there, so there's no reason to doubt it at this stage. If we see a break below the rising channel again, that would trigger for me a suggestion that we are going to see a move to the downside, especially if we fail to make a new high. Again, another big bearish signal, especially coming in such an important resistance zone. So the fact that we're seeing all three yen pairs approaching very important resistance zones, momentum appearing to fall out the move, that of course the trend is still bullish in all of them. So I'm not saying that that I'm all of a sudden a majorly bearish person with regards to these pairs, but I am getting very cautious around these levels, and I think it's worth noting if we do see a move high, then again this would be a very bullish move through the moving averages, and all of a sudden I think we're looking at another very important level around 152 to 153. Again, a 38.2% retracement of the June 2015 highs through to the October 2016 lows. Again, prior zone of support during the move down on a number of levels. You can see the congestion of previous support and resistance levels, but I'm not even convinced it's going to get that far at this stage. So let's see how it trades around these levels. If we see another rejection again, failure to make a new high and a break of the channel, then things start to look very bearish indeed. Let's have a look at cable. We're around 18 minutes in here, so I am a little bit cautious. I'm going to stick to the currencies today, I should say. I'll take a look at things like Brent and WTI and gold, etc., and maybe some indices on Monday. But we've got a lot to get through, and this video is already looking a little long for my liking, and I'm sure all of yours as well. You may be tuning into this video, but it doesn't mean you want to spend all day on it. Cable, we're continuing to look a little bit bullish here. We've had this rising trend line which has formed, and we continue to respect it. But what I find quite interesting is we've run into resistance here around these 128s. 128 is a level I've highlighted previously. Why? Because it's a big level of previous support, and it's also the 61.8% retracement of the move from the September highs to the October lows. And what I find interesting right now as well is that we're hearing more and more murmurings of the fact that people are getting too carried away in this sterling rally. It's maybe looking a little overbought. The fact that these murmurings are starting to happen when we're in a moving average band, the 55.89, 61.8% retracement level, prior level of support and resistance, this strikes me as being a little suspicious at this stage. We've got this trend line here. If we see a break of the trend line, We've had the rejection at resistance, we've had the rejection of the moving average. If we see a break of this trend line now, then I think that could signal a move back to the downside in cable. Now, that's not me saying I think we're going to head back towards 116. I don't, but I do think we could potentially establish some form of trading range here. And the next test for support is going to be these 123 to 123.80. Big level of support here, given that it's a prior area, the most recent area of support, and a break below this would be quite a bearish signal. Two currency pairs left. I will try not to hold you up too long, but I did want to get through Aussie dollar and dollar CAD, especially given that dollar CAD has been requested on the comments piece on previous videos. Aussie dollar, I think, still continues to look bearish. There's a couple of reasons for this. That is, of course, a big contributor. This consolidation, a little bit of profit taking, doesn't really deter me too much. We've had the rejection of the previous support, now turn resistance already. That also is consolidating around the 38.2% Fibonacci retracement. I have added an upper line to this rising wedge at this stage, but there's only 2 touches, so I'm not overly confident in that line at this stage. But this 75 level really does look important to me at this stage, and I'm not seeing any reason to doubt it quite yet. I'll be interested to see how this rising trend line from the bottom, again, only 2 touches, but if we see a break below that, then that may suggest that we are going to see it move back towards around these 72, 80, 73 levels once again. A rejection of the 38.2 again, though, as well, is quite a bearish signal. We've also got the 200 and 233 day simple moving averages coming into play around here as well on the Aussie dollar, which of course haven't been that reliable recently, I should state, because we have been in a roughly sideways trending market to an extent, and I think that has played a big part. But like I say, a breakthrough of this rising trend line would suggest to me that we're going to potentially head back towards these 73s, possible support along the way around these 73, 75s, with it being the most recent low. But all things considered, I think things could be looking a little bit more bearish for the Aussie dollar pair. Last but certainly not least, we've got dollar CAD. Dollar CAD trading in this nice rising channel, all of a sudden looking quite bullish. This series of higher highs and higher lows. What could possibly go wrong? Well, you look at the longer term and you see that we've got this previous high to a low. We've got a nice fib level on there, and where did it run into resistance? Well, it ran into resistance bang on the 50% retracement of the move from the January highs to the May lows. So all of a sudden you're thinking, well, is this going to break lower? Well, we've just made the new lower low by breaking through this 32.60 support, and we are heading lower again. Now, this level here around the 131 is going to be key for me as far as I'm concerned. Again, it's the lower end of this channel. The fact that we've had a lower low here is also already a trigger for me. If we get another lower high when we see another test to the upside, then that would suggest to me that we're potentially looking a little bit bearish once again. But again, a break of these 131s would mean a break of the channel and would suggest to me that this broader trend from the highs to the lows here, the 50% rejection, is coming back into play, and that would suggest that there's some more downside to come, with the next test coming around these 130s, which is the most recent major support in this dollar CAD pair. That's all we've got time for today. It has been a very long video. I do hope you all found it useful. If you do have any comments, if I'm speaking a little fast, I apologize. If you're struggling to understand me, I apologize again. Just mention it below in the video, and I'll be sure to hopefully make these videos a little bit better. Also, if there's any other pairs you want me to cover, please don't hesitate to ask. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.